Have you ever wondered why prices go up? Why the cost of food, rent, or fuel changes every year, sometimes every month? Or why some people seem to understand money so well while others are always struggling? Well, today we'll talk about something that affects every part of your life, even if you've never studied it before: economics and finance. Think of this as the minimum you should know to really understand how the world works and how to make better choices for yourself. So, let's start at the beginning. The world of economics. Economics is the science of how we use limited resources to satisfy unlimited wants. Every day, people, companies, and governments make choices about what to produce, how to produce it, and for whom. Imagine you have only 1 hour of free time. You can study, watch a movie, or go for a run, but not all three. Choosing one means giving up the others. That's economics in action: scarcity and choice. On a bigger scale, entire countries face this same situation. Should we invest more in education or healthcare? Build more roads or protect the environment? Resources like time, labor, money, and natural materials are always limited. So economics is the art of making choices wisely. Now, let's talk about the invisible forces that shape our everyday life: supply and demand. Imagine you're at a concert. There are only 100 tickets available, but 500 people want to go. What happens? The price goes up because demand is higher than supply. On the other hand, if a store has too many shoes that nobody wants, the price drops. This balance between what people want and what's available creates the price of almost everything you buy, from bread to Bitcoin. Prices are signals. They tell producers what to make more of and what to stop producing. When prices go up, producers make more. When they fall, producers slow down. It's a kind of language of the market, and it speaks louder than any politician or company announcement. GDP, the measure of a country's activity. Now that we know how markets move, let's zoom out a bit. How do we measure the total economic activity of a country? That's where GDP, or Gross Domestic Product, comes in. GDP is simply the total value of all goods and services produced in a country in 1 year. It's like the country's annual income. If GDP is growing, the economy is producing more. If it's falling, production is slowing down, maybe because people are spending less or companies are struggling. But GDP doesn't measure happiness or quality of life, only activity. A country can have a high GDP but still have inequality, debt, or social problems. So GDP is a useful tool, but not the whole picture. Inflation, when money loses value. Now comes a topic that everyone feels, but few really understand: inflation. People often say, everything is getting more expensive. But that's not exactly true. Prices go up because money is losing value. Think of it like this: if the government prints or creates more money, there's more cash in circulation, but the amount of goods and services doesn't increase at the same speed. More money chasing the same products means each unit of money is worth less. That's why your coffee costs more this year than last year. Not because the coffee suddenly became special, but because your currency can buy less. Governments sometimes create more money to pay debts or stimulate the economy, but that often leads to inflation later. And if they do it too much, the currency can collapse, like it has in countries that printed money to solve financial crises. Moderate inflation is normal in a healthy economy, but when it gets too high, it destroys savings, reduces purchasing power, and creates uncertainty. That's why central banks, like the Federal Reserve in the United States, carefully adjust interest rates to control inflation. Interest rates, the price of borrowing. Interest rates are one of the most powerful forces in the economy. They determine how much it costs to borrow money for a person, a company, or a government. When interest rates are low, people borrow more. They buy houses, start businesses, and spend more. This increases demand and helps the economy grow. But if inflation starts rising too fast, the central bank raises interest rates. This makes borrowing more expensive, slows spending, and helps stabilize prices. So, in a way, interest rates are like the temperature control of the economy. Too low, and it overheats. Too high, and it freezes. Government and the economy. Governments don't just collect taxes, they actively manage the economy through fiscal and monetary policy. Fiscal policy means changing how much the government spends and collects in taxes. Monetary policy means changing the amount of money in circulation and adjusting interest rates. These policies can be expansionary or contractionary. When the economy is weak, the government might use an expansionary policy, spending more money and cutting taxes to encourage consumption and job creation. It's like giving the economy a small push forward. But if the government spends too much or borrows heavily, it can cause inflation and debt problems later. When inflation is high, the government can take a contractionary approach, spending less, raising taxes, and letting the economy cool down. This helps stabilize prices, but it can also slow growth and increase unemployment for a while. Good economic management is a delicate balance, like driving a car through curves. Speed up too much, and you lose control. Slow down too much, and you stop moving. What is finance? Now let's move to finance, which is the practical side of economics, how money is used, saved, and multiplied. There are three main types of finance: personal, corporate, and public. Personal finance is about you. It's how you manage your income, spending, savings, investments, and debt. It's deciding how much to save each month, whether to buy a car or rent one, how to invest for retirement, and how to protect yourself from financial risk. For example, building an emergency fund protects you from surprises. Learning to invest helps your money grow faster than inflation. Managing debt keeps you free and independent. Then we have corporate finance, which deals with how companies manage money. Businesses must decide where to invest, how to fund their projects, and how to maximize profits while staying safe from risk. For example, a company may need to choose between expanding to another country or launching a new product. It must calculate if the expected return will justify the investment, using techniques like NPV, net present value, or ROI, return on investment. Finally, there's public finance, which is about how governments collect and spend money. Taxes, budgets, and national debt are all part of public finance. A government must balance social needs with financial responsibility, just like a family that can't spend more than it earns forever.
When governments borrow too much or print money to pay debts, they risk causing inflation, and in extreme cases, economic collapse. How it all connects. Economics and finance are not separate worlds. They are connected, like two sides of the same coin. Economic forces shape the environment in which financial decisions are made, and financial behavior, saving, investing, spending, shapes the overall economy. When people understand these connections, they make smarter choices. They can see how global events like wars, pandemics, or central bank decisions influence their own daily life. For example, when interest rates go up, mortgages and loans become more expensive. When inflation rises, your savings lose value. When the economy grows, companies hire more and stocks often rise. Knowing this doesn't just make you smarter, it makes you more conscious, more independent, and more prepared. Seeing the world through economic eyes. Once you start understanding these ideas, something amazing happens. You start seeing the world differently. When you hear that a country is printing money to pay its debts, you instantly know what will happen to prices and savings. When a politician promises free money, you understand where that money actually comes from. When markets crash or rise suddenly, you can connect the dots: interest rates, inflation, production, and expectations. You begin to see that the economy is not a distant system. It's the reflection of human behavior, our hopes, fears, and decisions multiplied by millions of people. And finance is simply the language we use to measure those decisions in numbers. Why it matters for you. Understanding economics and finance changes the way you live. It helps you decide where to work, what to study, how to invest, and when to take risks. It helps you stay calm during crises and think long-term when others panic. More than that, it helps you understand why the world is the way it is, why some countries grow faster, why others fall into debt, and how small changes in policy can affect billions of lives. Knowledge gives freedom, and financial knowledge gives real-world freedom. Because when you understand money, you stop being controlled by it. You stop reacting blindly to news, prices, and emotions. You start acting with awareness, seeing the big picture. So, next time you buy something, pay taxes, or hear about inflation on the news, remember, you're part of the economy, and every decision you make, how you spend, save, or invest, shapes the world around you. Economics is not about numbers, it's about choices. And finance is not about wealth, it's about using what you have wisely. When you understand both, you don't just make better financial decisions, you understand life a little better.